Assalamu alaikum. Have a good day. Welcome to Financial Management eLearning. So today we're going for taking Strategic Management Accounting Module 2. This is the continuation of previous module. It is capital budgeting continuing. So today we will learn conversional and non-conversional cash flow, free cash flow, capital budgeting evaluation methods, discounting cash flows, non-discounting cash flow, and we'll take 4 exercises: ranking of investment projects, calculating working capital requirement, and evaluating the changes in the trade receivable policy, evaluating a change in trade receivable policy, expansion type project. So let us start. Basically, you know everything because you are the professional and you have studied in your different levels. So conventional and non-conventional cash flow. This is the conventional cash flow. Look, it is a series of cash flow which changes direction only once, which means that if the initial cash flow is outward, it will be followed by a series of inward cash flow or vice versa. For example, just one-time cash outflow and whole life of the project cash inflow. So it is the conventional cash flow. If non-conventional cash flow, look, is the exact opposite, which means that there might be more than one chance to direction of cash inflow or outflow. Okay, look here, non-conventional cash flow. Here, cash outflow 2 times, initial year and another within the life of the project. So directly we can say that if the outflow just one time within the project, that is conventional, and outflow more than one, then non-conventional cash flow. So guess so? Yes. So another thing now, free cash flow. So we know the cash flow, and as per International Accounting Standard 7, cash flows, we prepare cash flow, and within the cash flow there are 3 activities: operating activities, investing activities, and financing activities. So what is free cash flow? Look, free cash flow represent the cash of a company generate after accounting for cash outflow to support operation and maintain its capital assets. Look, unlike earnings or net income, free cash flow is a measure of profitability. That means capital expenditure commitment consider with the cash flow. For example, if we see the right side, the formula of free cash flow, operating cash flow minus capital expenditure minus working capital. So look, FYR, a company. I think you know the who is FYR. The operating cash flow 50,000, capital expenditure, that means capex 15,000, net working capital 25,000. So we can calculate the free cash flow by using the below formula or above formula. Free cash flow equal to operating cash flow minus capital expenditure minus net working capital. Just if that means operating cash flow 50 minus capital expenditure 15 and net working 25. So 25 and 15, 40,000, and free cash flow would be 10. Okay. So free cash flow is clear? Not sure. Okay. Then capital budgeting evaluation method, we know there are different types of method. Some are discounted, some are not discounted. And not discounted as payback period, accounting rate of return, and discounted, that means consider the time value of money. Net present value, generally we know is NPV, internal rate of return, profitability index, and discounted payback period. So here, accounting rate of return, information use accrual accounting amount, and time period covers average of all years of a specific life. Payback period, cash flow, not discounted until cash is recovered. That means cash flow not consider the whole series of cash inflow. Net present value, discounted cash flow, entire life of project. That means NPV consider time value of money as well as full or whole cash flow within the period. Internal rate of return as same as NPV. So discounted cash flow method is valuation method used to estimate the attractiveness of an investment opportunity. DCF analysis uses future free cash flow projections and discounted them to arrive a present value estimation. So this is the formula. I think you all know it. So capital budgeting techniques, some are traditional, some are modern. Traditional payback average, in modern NPV IRR, modified IRR, profitability index. It all are the discounted cash flow method, and that are the equity method, entity approach, equity method direct valuation, entity approach indirect valuation, adjusted present value approach, total cash flow approach, weighted average cost of capital approach is the entity approach. So, but the future value, it turns into discounting, we receive the present value. Okay? So non-discounted method is capital budgeting does not express the consideration of the time value of money. That means not considering the time value of money. Okay. And capital budgeting method model accounting rate of return. This is the formula. Average annual net profit divided by initial investment or average investment. Payback period, net initial investment, increase in cash flow. Internal rate of return, this way, NPV would be 0. Profitability index or benefit cost ratio. Here, PI would be positive more than 1 would be acceptable. NPV, this is the NPV's formula. Okay, so we will do a lot of, we'll solve a lot of problem in our future modules. The ranking of investment project. Why we rank it? Because for the organization or investor, there are lot of project. Think that 3 or 4 project all are the positive NPV. So you have to, or we have to rank it. So which project gives us the more NPV? So ranking, the decision of project ranking plays significant role in the decision of capital investment, because depending on the various project the firm is having at a certain period, the firms prioritize the project. The ranking of the project depends on how much a project will return and which project will be able to add maximize value of the organization. Okay, so here a problem number 1, the ranking of investment project. Here fund needs all of the project 1, 2, 3, 4. Think that here number 4 projects are here. Fund need 960,000, 720,000, 540,000, 9,000. Present value of cash inflow all calculated. So NPV, net present value, means NPV is positive 174,540, 14680, 132,280, 154,940. Project life 6 years, 12 years, 6 years, 3 years. Internal rate of return IRR 16%, 14%, 18%, 19%. Due to limited fund, all project cannot be accepted. That's why the project we have to rank it. So what is the requirement? Compute profitability index, present value index for all the project. Okay, then rank the 4 investment project according to NPV, profitability index, and internal rate of return. So let us start. It's easy. So computation of profitability index, also we can call it present value index. Profitability index can be computed. The formula is profitability index equal to present value of cash inflow divided by initial investment. The profitability index, PV of future cash flow, initial. For example, project 1, PV of cash inflow is 1134,540. Okay, and initial investment 960,000. Okay, so here 960,000, look, and present value of inflow, so we get 1.18. So all 4 project, if we calculate, look, 1.18, 1.20, 1.24, 1.36. Okay, so ranking of investment project, what we will rank, that means according to net present value. Look, NPV is higher where project 1 is higher, then project 2, then project 4, then project 3. Look here, project 1, 2, 4, 3. Clear? Then according to profitability index, look, 1.8, 1.20. So more is project 3. So look, project 3 is more number 1, project 2, then project 1, then project 4. Okay? Clear, sir? Okay. Then according to internal rate of return, look, internal rate of return, more is 4, then 3, then 1, then 2. No, 4, 3, 1, 2. Okay? So ranks. If company wants to invest according to NPV, should be choice project 1 first, then 2, second, third, and fourth, and 3. This way. So, okay, this is the ranking. Now, we are going to calculate working capital required. The amount of working capital required by a company can be estimated from information on the value of the relevant working capital input and output. So we know what is working capital? Current asset minus current liabilities. Then we'll get working capital, such as the raw material cost and credit purchase, together with information on the length, the component of the cash conversion cycle. Assuming that Muttakin PLC expects the credit sale 18 million USD. The production cost as follows: raw material, direct labor, production overhead, and total product cost 12 million. Raw materials are inventory for an average of 3 weeks. So raw materials have to keep as inventory for 3 weeks. This is the part of working capital. That finished goods are inventory for the average of 4 weeks. Okay, it's also part of working capital. All raw materials are added at the start of the production cycle, which takes 5 weeks. Okay, the work in progress in 5 weeks, and incurred labor cost and production overhead at a constant rate. Okay, suppliers of raw materials allow 4 weeks. That means your creditor, that means the companies pay the creditors after 4 weeks. When the customer are given 12 weeks to pay, that means companies receiving amount from the debtors 12 weeks. The product takes place eventually throughout the year. Okay, so requirement is calculate the total working capital requirement. Now evaluating it. Okay, first we have to solve the working capital rule. Raw material 4 million. How we get this 4 million? Okay, divided by 52, that means weeks, multiplied by 3 weeks. How we get 3? From where we get 3? This 3 is there, here, look, 3 weeks. Raw materials in inventory for an average 3 weeks. So this 3 weeks, so raw material 230. Now work in progress. Raw material 4 million divided by 52, multiplied by 5. So how 5? This is where, look, 5 weeks. These 5 weeks, work in progress. So the figure is that labor cost also throughout the year eventually, that means average to 50%. So that, okay. Then overhead also 50%, 3,552,000. Finished goods, keeping the inventory for 4 weeks, that figure Okay. Then trade receivable 12 weeks, payable 4 weeks. Payable here is minus. Then working capital required 57,69231. So okay. And note that Muttakin cash conversion cycle 354 plus 12 minus 4 weeks. That means 20 weeks. Now, evaluating a change of trade receivable policy. Muttakin PLC has annual credit sold 15 million and allow 90 days credit. It is considering introduce 2% discount of payment within 15 days and reducing the credit period 60 days. It is estimated that 60% of its customer will take advantage of the discount, which will volume of the sale will not be affected. The company finance working capital for overdraft at the cost of 10%. Is this proposed change policy through implementing? Is a question to you. So let us start the finishing thing, evaluating the item. Current level of receivable 15,090 days 3699. Proposed level of receivable 15,360 60 40% and 60% total. This reduction on receivable 2346. So here one thing, 60 days 90 days, and estimated that 60% customer will take the advantage. That means this 60% is this 60%. Okay. And saving of finance cost 32340, this figure 10%, because this amount receiving from the bank overdraft, that means 10%, the cost is that. Cost of the discount 2% 16 180. So net benefit of proposed policy change 54. This is the, it would be benefited. Okay, company will be benefited. The policy change is financially attractive. However, the difficulty of forcing accuracy of the effective of the change in the trade receivable policy should be borne in mind while deciding the whether or not introduce it, but it is positive. Okay, so another one, expansion type of project. Here, I think this math you have done a lot of times. FOR is a considering the purchase of industrial introduce the lock check. The firm does not currently own the machine. A machine, a consultant paid to 56 months ago, estimated relevant cash flow, which is summarized below. Incurred say 5 lakh, additional revenue 4 lakh annually, cost 1.4 million, shipping cost 3 lakh, 1 lakh in installation 3 lakhs, 1 lakh shipping cost, etc. The company and after tax cost 2 lakh, train staff up for operation. The firm would also need to increase the stock of eggs, hatchery for 5 lakh, The company plans to issue debt to fund the project, and this will increase interest expenses 4,65,000 per year. The machine will be depreciated towards salvage value 4 lakh, and depreciation life is 5 years. At the end of the machine, useful life expected that sold 5 lakh. Then NBR will also given the firm tax credit 74,993. At the end of the project, agreed the firm partial recovery imposed duty. Acquired as a cost of capital 20%, and the tax rate 33.3%. NPV calculation, PI calculation, project acceptable or not. Is the working? So initial outlay 25. Okay, and sale of new machine 1041. So NPV is minus 7812.38. PI 0.99, also PI negative. The project should not be accepted. Because why not accepted? NPV is negative, also PI is less than 1. So this project would not be viable for the company. And another replacement site project. So today we are finishing here. So we'll meet you again with my third or next module. So till then, take care. Thank you for watching. Goodbye. Allah Hafiz.